All right, we're on learning objective 10.2, and here we're going to go through the mechanics of actually calculating depreciation. We learned the journal entry way back in chapter 3, and if you'll remember, that journal entry was to debit depreciation expense and credit accumulated depreciation. Remember, that is a contra asset account. So it has a normal credit balance, but it is within the assets. Okay. So let's get to it. Here we go. There. Okay. So we want to pick a depreciation that matches as close as we possibly can, the revenues that we're generating from the asset. All assets except land, which I've already said that several times now. Land is not depreciated. Most everything else is going to wear out as they are used. Okay. Some things are going to last us longer, like a building, house, but the cars we drive, those aren't going to last quite as long. Okay. Some assets will become obsolete before they wear out. I always think of it's not quite as much as it was, but maybe 20 years ago, technology was just growing so fast that, like, if you bought a computer 1 year, it'd almost be obsolete in a year, maybe 2 years. I remember wearing computers out about every 2 to 3 years. Um, I don't do that anymore because the technology isn't growing as fast at a rapid rate. So you don't see that as much. But things like your phones, if you've got a warehouse full of iPhones and the old ones aren't getting sold, those are gradually becoming obsolete. Okay. So there are three things that go into calculating depreciation. We have the cost, which we just learned in the previous video, how to find the cost of an asset. Then we have the useful life. How long do we plan on this asset lasting us? And then the third thing is residual value. Sometimes I will call it salvage value. It is the exact same thing. Okay. I use them synonymously. So if you hear me say residual value or salvage value, I mean the exact same thing. Okay. We have this thing called depreciable cost. It is just the cost minus the residual value. Okay. That's just definitional type things. We'll kind of talk about it as we go through the mechanics of actually working some of these. Okay. So we're going to learn three depreciation methods, and we have an example right here of a truck. Here's a cost. Here's the salvage value. That's the depreciable cost. We're going to do this under three methods, so we actually need the useful life in years and the useful life in miles. Okay. So I'm going to jump over here because I just copied that slide and came over here. Anytime you get a problem like this, I always write down a little blurb of information just so that I know. I don't have to go dig through a paragraph of information to find what I need to actually do the calculation. Okay. You really only need three things, and I know they got five listed here, but you have the cost. I'm going to write these out and I'll show you how to do it. We have the salvage value or residual value, which is 1,000, and then estimated life. I am going to put 5 years or 100,000 miles. Okay. We will only need one or the other when we're doing each one of these. Okay. All right. So we're going to start on the easiest one there is, and it's probably the one that is most used just because it is really easy. Okay. So we have straight line depreciation. Okay. We are going to take the cost minus the residual value, divide it by the estimated life. Okay. They'd already calculated that depreciable cost, which is this cost minus residual value. So that is equal to 40,000. Let me write it out so you kind of see the mechanics a little better. We have 41,000 minus 1,000 divided by 5. Okay, so let's come over here because I haven't actually worked this or have it written in front of me. So we have 41,000 minus 1,000, and we're going to divide that by 5. We get 7,800. Okay, so year one through year five, every single year, we will depreciate 7,800. Okay. They have a nicer little presentation. Oh, I did something wrong because it's not 7,800. It is, I don't know what I did wrong. Oh, I took another 1,000 off. Let's go back and fix this because it looks like I can't do math. I just punched in the calculator wrong. I can do math. 41,000 minus 1,000 divided by 5. It's 8,000. Okay. Glad I jumped over there. So let's go over here because, and they show you the journal entry. Remember, I said journal entry is going to be the same every single one of these. Okay. Debit depreciation expense. Remember, that is an income statement account, and your accumulated depreciation is a contra asset, and it will be on the balance sheet. Okay. That's the journal entry. We're not going to get hung up on the journal entry because you should know how to do the journal entry. I'm going to come down here and show you theirs graph, our little table where they have the depreciation. And you can see right here, every single year, that accumulated depreciation account is going up and up and up until it hits the 40,000. Okay. It cannot hit 41,000 because we have to leave $1,000 in there for the residual value because we're going to get that back at the end of this asset's useful life. Okay. So now let's come over here and we're going to do, that's the easiest. We're going to units of production. Okay. Very similar to straight line. It will be cost minus the residual value. And instead of estimated life, we're going to use estimated miles. Okay. We have 41,000 minus the 1,000, and we're going to divide that all by 100,000 miles. So instead of a per year amount, we are going to get a per mile depreciation. It's about to do that again. I really like my iPhone calculator, but you can't see that. Okay. We're going to divide that by 100,000 miles, and we get 40 cents per mile. What in the world am I going to do with that, Miss Solano? What is 40 cents? Well, we're going to look at a logbook on how many miles that this delivery truck has been driven, and we're going to depreciate it 40 cents per mile. So let's jump over here real quick because there's more information than what they gave us right here. So they gave us here are the number of units. That was not up in that graph. That would be somewhere else. You notice we're taking 40,000, I'm sorry, 40 cents, multiply it times 20,000 to get 8,000. That's just a coincidence that straight line and units of production have the exact same amount. Totally coincidence. Okay. That's not like a rule or anything. I hate it when they're like that because then it kind of confuses you just a little bit, thinking that it should be the same, but it is not. Okay. The journal entries are going to be identical. Okay, let's see. They do not make a journal entry here, which is fine. Notice then they use the truck more in the next year, and then a little bit less, and then a little bit less, and a little bit less. And doesn't that make sense? When we first get a new vehicle, we usually drive it a lot. Just in our house, we've got several drivers, And, usually when the new car comes home, that's the one that gets drove quite a bit because it's new. It probably gets better gas mileage. It's probably not going to break down on us. By the time we get down here, it could leave us it could leave us stranding. We don't trust it as much anymore. We're still using it, but we might already have another new car or new delivery truck that we are using, and we're driving it more and driving this one less. Okay. Still has to leave that $1,000 residual. Okay. We're going to do the next one, double declining balance. And guess what? When we get to this little table, that $1,000 will be there as well. This 40,000 will be the ending and accumulated depreciation. So when you're working a problem like this and it wants you to do all three methods, if you get to double declining balance, which is the hardest one, and you're like, I don't have any idea what I'm doing here, but hey, I know that it's gonna have an ending accumulated depreciation of 40,000 and the book value at the very end will be 1,000. Fill those numbers in, get those points, okay? Don't look at something like this as a lot of opportunities to miss. Look at this as there's a lot of opportunities to put things in and you still may not even have a clue what you're talking about, but sometimes you'll start filling it in and you're like, "Oh yeah, that makes sense." Okay? So, all right, now we're going to do double declining balance. And I am going to come over here and I want you to watch me. This is the hardest one we're going to do. Um, Double declining balance is basically 200%. Okay. Double declining balance. We could have triple declining balance, quadruple declining balance. I've never seen those. You could even have 150% declining balance. Okay. It is an accelerated method. Okay. Keep that in mind. It is an accelerated method. It's going to look very different from the other two. All right. So, the first thing we're going to do in double declining balance is find the straight line rate. The straight line rate will be 1 divided by the number of years, not miles, years. Okay. So for this problem, my straight line rate is 1 divided by 5. Or I'm just going to go ahead and put it as a percentage, 20%. Second step, I'm going to take that 20% and I'm going to multiply it times 2 or 200%, and that will give me 40%. Okay. That'll give me 40%. All right. So what we're going to do for the very first year, and I'm going to look back those years. The first year was 26. I'm going to say year one just to make it a little bit easier. Okay. So year one, we're going to take the cost of the asset. We're going to take the 41,000, not the 40,000. You'll kind of see why as we get down to the bottom of this, okay? Because we can always take a percentage of a number, so we leave the residual value in here for now, okay? I'm going to bring this down a tiny bit so it's not up bumped up against. I'm going to just put balance. So it's okay. That balance, we're going to start with 41,000. So we're going to take that 41,000. We're going to multiply it times 40%. Remember, we do not take the salvage value out on the front end of this one. We're going to multiply that times 40%. That gives us 16,400. This is my depreciation expense for year one. Whoa, that's crazy. That's over double what it was from the other two methods. It's because it's an accelerated method. Okay, it's a method to depreciate this faster. Okay, we come down to year two. We're going to take the 16,400 away from the 41. I'm just going to put it right here so we can get a year two balance. Okay. Let's take 41,000 minus 16,400 gives us 24,600. Okay. That's my balance. Double declining balance. It's a declining balance here. Okay. We got that number in our calculator. We're going to go ahead and multiply it times 40%. Again, that's 9840. I am going to jump over here and check my numbers real quick because I want to make sure I'm on the right track. Yes, I am. So we got that for depreciation expense and then the 9840. All right. So now I'm going to come down to year three. I'm leaving myself just a little bit so I can put that right there. And then I'm going to find my calculator here. And I'm going to take 24,600 and subtract 9840. Okay. That will give me 14,760. Okay. We're going to multiply that times 40%. Okay. We've got that number in our calculator. There we go. We're going to multiply it times 0.40, and that will equal 5,904. We're just going to keep on going. You can see we keep on going here. And then we're going to subtract that 5,904 from that balance. And let's take 14,670 minus 5,904. And I did that wrong. 14,760. Oh, I see what I did. Okay. Minus 5,904 gives me 8856. We're going to multiply that times 40%. Okay. And so I've got that number in my calculator, so I'm just going to leave it there. Multiply that times 40%, and we end up with 3542. All right, so we have the 3542.4. I want to jump over here and I want to see if they rounded that. 3542, they took those cents off, okay? Which is perfectly fine, okay? So we're gonna come down here, subtract that 3542 right here. Year five, we're gonna get a balance. You have 8856 minus 3542. And that gives, I cannot put this in the calculator today. Sorry. 8856 minus, I think I'm hitting the divide, 3542. There we go. So we end up in year five with 5314. Okay, 5314. I believe the instructions told us to end it in year five because we probably should have kept going on this last year. Okay, because double declining balance usually works to where you just keep on going on this until you get to where you're at that $1,000 residual value. Okay. So in this one, eh, sometimes I don't know why it does that. Sorry. Oops, there it is. Double decline. That's not it. That's the comparison. Here we go. Okay. So in we had the 5314. which was the book value or balance. Let's see, 5314. In this year five, we are just going to subtract the $1,000, and our depreciation for that year will be 4312. Okay. So just read the problem. We were probably supposed to keep going on that. I know it's a 5-year asset, but it just depends on how um, much the salvage value is. So let's just say, for example, if the salvage value had been 10,000, we probably would have stopped right there in year four or probably year three because we would have depreciated it too much if we continued the 40%. So this is a good problem to put in Excel, and then you just drag and drop your formulas, and then when you see it go to, there's no salvage value, go back and adjust that last line. Okay. But double declining balance looks crazy because it's so much on the front end and it's an accelerated method. So it does tend to do that every single time. Okay. All right. So now we're going to compare all of these. Okay. I could argue every one of these. You might be asked, this is where I said, you might be asked to fill in this chart and you get down here to double declining balance and you're like, I just made a decision not to learn that, Miss Solano. That is perfectly fine if you do that, but you still have to pass the class, whether you learn it or not. Know that every one of these will end up with that depreciable cost or total accumulated depreciation. Okay. Um, I personally think buildings do really good as straight line because it's really hard to get a usage on a building. Say, for example, you're in a college, we might be in a classroom working problems, and in that classroom, there could be 50 seats and only one student. I've done that before. Or we could have 50 seats and 50 students in there. I've done that before too. Okay. It doesn't matter how many students are actually sitting in those seats, that building is depreciating the exact same amount. Okay. Things like the delivery truck that we can actually get a unit of production, that is a really good use of units of production. It'd be really hard to use units of production on a building and how many students are in it, because that would be just be a very almost an estimate that nobody could ever estimate. Okay. Then double declining balance. It is an accelerated method. I told you I can argue this one too. Think about if you buy a new car and you drive that new car off the lot. There are cases where things like that depreciate a lot in the very first year. Okay. But it is an accelerated method. We are accelerating the depreciation so that we can start planning to buy the next asset. Okay. So they give you a little bit of information there and they give you a little chart here on straight line and units of production. Even in the graph, you can kind of see how crazy double declining balance is. Okay. We are talking about depreciation for financial purposes. We are not talking about depreciation for IRS purposes. We IRS has what we call MACRS, Modified Accelerated Cost Recovery System. They have these tables and they are divided out, and it makes it a lot easier to apply depreciation for tax purposes. So you might be using a different method for financial purposes, and then the IRS says you have to use it for their purposes, and that's okay. You can do that. We actually do kind of keep two sets of books in accounting when it comes to this. We have reconciliation between those two. This is one that's going to be a difference between that we would do a reconciliation later on. Okay. Makers is not acceptable for GAAP. If we're just like a small sole proprietorship, we can probably use makers as ours and keep it the same. But if you're a corporation and you're required to use GAAP for financial reporting, you can't use makers. Okay. It's not going to give us good information. It is just what the IRS came up with. Okay. The last thing in this section is a partial year depreciation. Okay. We could do the modified half month convention. This is used on assets purchased during the month. So we would record the depreciation for an entire month if the asset was purchased on or before the 15th. We would record none if it was after the 15th. Okay. Here for, and now we are talking about financial reporting purposes, they give us this example. Assume the truck, this is the exact same one we did, had cost of 41,000, residual value of 1,000, and a 5-year life. We know we've already calculated it, and we know that every year it's going to be calculated at $8,000. We don't really have to go through all of this calculation. We can just take the 8,000, cut it in half, and we have our 4,000. That makes it a lot easier than to go through all of this and have fractions when it's very simple. Just cut it in half. Okay. Next thing we're going to talk about is changing estimates of depreciable assets. So when I first started over here with the mechanics of all of these depreciation, the estimated residual value and the estimated, let's come down here. These two things are estimates. We really don't know if we're going to get $1,000 at the end of its life. We really don't know if it's going to last us 5 years or 100,000 miles. It may last us 3 years. It may last us 200,000 miles. It's an estimate. We don't know for sure. Okay. But as time goes on, you might find out, oh, okay, this asset's really not going to last us 10 years. It's really going to last us only 5. You're always going to change the depreciation going forward. You never go back to previous years because your previous years you were using an estimate that was the best estimate you had at the time. Now we're here at the present, and at this moment, we're looking forward and we only look forward. We do not look backwards when we are changing estimates. Okay. All right. So this example, Smart Touch Learning used a truck purchased on January 1st for 2 full years. The truck cost, this is the exact same problem, 41,000 residual value and 5-year life. Okay. We know that $8,000. We know that because we've already calculated that. Okay. They depreciated it for 2 years, so we know that we've depreciated it 16,000. This might help if I drew out, sorry about that. Let's come over here and let's draw some T accounts out. We have the truck. Truck is sitting in the asset account for 41K. We have that accumulated depreciation for the truck. We've depreciated it 2 years. I'll just do 8,000 and 8,000. And so right now, this asset has a book value of 25,000. Remember, way back in chapter 3, I told you book value is not the same as fair market value. Book value is what we are carrying it on our books as. This is one of the things that gets very confusing in accounting because if y'all have traded a car in, you know what they're talking. They're talking about a book value. That is really fair market value. Okay. So our book value is 25,000. They said it was going to change. They haven't told us yet over here. They said Smart Touch Learning believes the truck will remain useful for 6 more years for a total of 8, and the residual value stays unchanged. We do not go back and fix or try to reinstate that 6 years on those 2 years. We leave the 8,000 from those prior 2 years. We're going to calculate a new depreciation. The book value is what's going to sub in our cost. We'll start with that as our cost. So we have 25,000 minus 1,000 divided by 6, not 8. 8 is the total, but we've already depreciated it out 2 years. So we'll divide that by 6 and then we will end up with 4,000 per year for the rest of that asset's useful life. Okay. The entries from year 2028 through 2033 are exactly the same. Debit depreciation expense for 4,000, credit 4,000 to accumulated depreciation. All right. This was a long section. I do apologize. How does it look when we present this on the balance sheet? I believe I showed you this, so this should just be a review. Notice we have land. Notice land doesn't have an accumulated depreciation because we don't depreciate land. Okay, our building has some depreciation in it. And notice this is that contra asset account. Remember, let me find my T accounts up here. What's my cheesy saying? They're married till death do them part. They can't get a divorce. They are going to be together. Even if you depreciate that building or furniture all the way to where the book value is zero, you still list it. You still list both accounts on the balance sheet if you are still using it. Okay. So you can see how that accumulated depreciation is bringing down the value, the book value of these assets. Okay. So this might be the note, and notice that number right there. This number might go to the financial statements, and that's all you see. And then this detail would be in the notes to the financial statements. All right, that was a long video, I know. So we are done with Learning Objective 10.2, and we are moving on in the next video to Learning Objective 10.3.